In this video, we'll unveil the timeless wisdom of the Oracle of Omaha himself, Warren Buffett, as he imparts his invaluable investing tips and rules for investors, both beginners and seasoned pros. Get ready to decode the stock market investing strategies that are shaping 2023. Rule 1. Don't lose money. According to Warren Buffett, the first rule of investment is don't lose, and the second rule is don't forget the first rule. In essence, Buffett's focus is on preserving capital and minimizing losses. Buffett's philosophy revolves around buying assets for less than their intrinsic value. He suggests building a portfolio of such undervalued assets to reduce the risk of losing money. This approach may seem straightforward, but it's a powerful principle that keeps investors grounded. One crucial aspect of this rule is keeping an eye on valuations. Ensure that you purchase businesses for less than their actual worth. By doing so, you substantially reduce the likelihood of losing money. Buffett advises that if you find yourself in a difficult situation, the best course of action is to stop the losses from growing further. This means avoiding the temptation to double down on losing investments and instead considering cutting your losses and moving on. A recent example of this approach is Buffett's investment in Taiwan Semiconductor. He realized he made a mistake and promptly sold the stock. However, because he bought it when it was undervalued, his mistake didn't lead to significant losses, and he might have even made a profit. Rule 2. Long-term holding periods. Warren Buffett's next rule is crystal clear. Don't hold a stock for 10 minutes unless you're willing to hold it for 10 years. This principle emphasizes the importance of thinking long-term when investing in stocks. In other words, you shouldn't buy stocks with the intention of selling them quickly. Buffett emphasizes that investing is as much about psychology as it is about intellect. To succeed, it's crucial to focus on the long-term potential of the businesses you're investing in. Instead of constantly checking stock quotes, think of it as if you were buying a farm and never looking at its daily value. Buffett's own portfolio is a testament to this approach. He has held companies like American Express, Coca-Cola, Bank of America, Visa, and Moody's for more than a decade. For example, he purchased Coca-Cola in 1988 for about $1.3 billion, and today it's worth a staggering $24.8 billion. The power of long-term compounding has rewarded him handsomely. Think long-term and avoid the short-term gambling mentality. Rule 3. Buy businesses you understand. Buffett's third rule advises investors to stick with businesses they understand. He emphasizes the importance of investing in companies whose future economics you can reasonably predict, whether it's 10 or 20 years from now. Evaluating a company within your circle of competence means you understand its operations, economic dynamics, and competitive position. Many novice investors make the mistake of using stock screeners to find seemingly undervalued stocks without truly comprehending the businesses behind those stocks. This lack of understanding can be problematic because when stock prices inevitably fluctuate, they may panic or make irrational decisions. Imagine you purchased a stock and its price suddenly dropped by 30%. Would you consider it a better deal or assume something fundamentally changed, requiring you to sell? The answer often lies in your level of understanding of the business. If you've thoroughly researched and understood the company's operations, competitive advantages, and future prospects, you'll be better equipped to make informed decisions during market fluctuations. Rule 4. Always buy below intrinsic value. Warren Buffett's fourth rule is all about buying assets at prices lower than their true worth. To understand this, think of investing as a way to lay out money today in the hope of getting even more money in the future. It's not about quick gains. It's about long-term growth. Buffett uses a method called discounted cash flow analysis to calculate intrinsic value. This analysis helps him determine if the current market price is an attractive buying opportunity. It's a more systematic approach to check if you're buying below intrinsic value. A fantastic example is Buffett's investment in Apple in early 2016. At the time, Apple had a market cap of around $600 billion and a price-to-earnings ratio, PE, of 12. Despite the size of the investment, Buffett recognized Apple's strong position and expected it to generate more cash over time. He bought the stock, and today, Apple's market cap is approximately $3 trillion, with its free cash flow nearly doubling. This example highlights the importance of buying below intrinsic value and holding for the long term. Rule 5. Seize your opportunities. Warren Buffett's next rule is all about recognizing golden opportunities and acting upon them decisively. It's about hitting those home runs when everyone else believes the sun won't rise tomorrow. However, these opportunities are rare, and you won't encounter many of them in your lifetime. Whether it's in investing or life in general, when you have a chance to do something right and significant, take it. In the world of investing, exceptional opportunities are far and few between. To make the most of these rare chances, you need to be prepared both psychologically and financially. Most people will let these opportunities pass them by. Instead of researching the stock market or making informed decisions, they may get distracted by other activities. The key takeaway is to be proactive. If you're serious about investing, take action. Write down your investment goals for the next month. It could be as simple as investing your first $500, reading a company's annual report, or studying a famous stock market book. Putting a plan in place and following through is crucial. Don't just listen to the wisdom of the world's greatest investor and then do nothing. Buffett emphasizes that the most significant mistakes he's made in his career were not commissions, but omissions. He missed opportunities because he hesitated or didn't act when he should have. For example, he mentions missing out on investing in Fannie Mae, a financial institution, when it was facing difficulties. He didn't know enough about the company, so he passed up the opportunity, ultimately costing Berkshire Hathaway billions of dollars. Rule 6. Don't buy cigar butts. Warren Buffett's sixth rule is a shift in his investing philosophy. He once followed the cigar butt approach, inspired by his mentor Ben Graham. This approach involved searching for cheap stocks that might look ugly but still had some value left, much like picking up a discarded cigar with one last puff. In the past, Buffett scoured the market for these undervalued, albeit imperfect opportunities. The idea was that by buying a diversified basket of these cigar butt businesses, overall returns would be favorable over time. However, he later realized that while this approach could yield profits, it wasn't the most efficient way to build significant wealth. Buffett changed his perspective and adopted a different approach. He now prefers to buy high-quality businesses at fair prices rather than fair businesses at wonderful prices. This shift in thinking has likely been the most significant factor in Berkshire Hathaway's remarkable growth. Buffett's insight is that it's far more straightforward and lucrative to invest in excellent businesses with strong competitive advantages, long-term growth potential, and solid management teams. While you may not get them at rock-bottom prices, holding onto these companies for extended periods can lead to substantial returns. We've already seen an example of this with Apple. Buffett recognized the quality and future potential of the company, even though he didn't purchase it at an extremely low valuation. His focus was on the business's intrinsic quality and long-term potential, not just the stock's immediate price. Rule 7. Be greedy when others are fearful. The final lesson from Warren Buffett is a timeless one. Be greedy when others are fearful, and fearful when others are greedy. This statement highlights the role of human psychology in investment decisions. People tend to act strangely when it comes to investing. They get excited when others are excited, greedy when others are greedy, and fearful when others are fearful. This herd mentality often leads to market inefficiencies and opportunities for astute investors. Buffett has witnessed these behavioral patterns throughout his career. He's seen investors pour money into the stock market during times of extreme optimism and then abruptly withdraw during periods of pessimism. This pattern repeats itself, even though it defies rational thinking. For instance, during bull markets, investors get carried away by the prospect of quick profits and push stock prices higher. In contrast, when they look back and see losses, they quickly abandon the market, fearing further declines. These reactions often have little to do with the underlying business fundamentals. Buffett points out that these behavioral tendencies create enormous opportunities. When investors panic and sell off stocks, prices often drop to levels that don't reflect the true value of the businesses. This creates a significant buying opportunity for those who can resist the emotional roller coaster and stay rational. One notable example is Buffett's actions during the 2008 financial crisis. As the banking system was on the verge of collapse, he invested in companies like Goldman Sachs and Mars. In 2011, he bought shares of Bank of America. These investments were made when most investors were gripped by fear and the market was in turmoil. If you want to learn more about the secrets of wealth generation, here are 14 closely guarded secrets for massive wealth creation that only billionaires know. You don't want to miss out on them.